and gentlemen, good day and welcome to the earnings conference call of Dalmia Bharat Limited for the quarter and year ended 31st March 2024. Please note that this conference will be for 60 minutes, and for the duration of this conference call, all participant lines will be in the listen-only mode. This conference call is being recorded, and the transcript may be put on the website of the company. After the management discussion, there is an opportunity for you to ask questions. Should anyone need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. As a reminder, all participant lines will be in the listen-only mode. Before I hand over the conference to the management, I would like to remind you that certain statements made during the course of this call may not be based on historical information or facts and may be forward-looking statements. These statements are based on expectations and projections and may involve a number of risks and uncertainties such that the actual outcome may differ materially from those suggested by such statements. On the call we have with us Mr. Puneet Dalmia, Managing Director and CEO, Dalmia Bharat Limited, Mr. Dharmender Tuteja, CFO, Dalmia Bharat Limited, and the other management of the company. The earnings release has already been uploaded on the company's website. With this, I will now hand the conference over to Mr. Dalmia for opening remarks. Thank you, and over to you, sir.
Good morning, everyone. I will begin with an overview of our performance, and then Dharmender will provide a more detailed explanation of our operational and financial aspects. During the quarter, we have delivered a healthy volume growth and have regained our market share. If you recall, we had lost market share in the first half of the year. We undertook some corrective actions, and subsequent volume recovery during the last 2 quarters makes us believe that the whole issue is now behind us. While we have regained market share, the volume growth has come at a higher cost. During the quarter, the prices in our key markets declined, and due to lower realizations and higher cost, our EBITDA per ton declined to 743 rupees per ton. The price drop in Q4 is far more than what we have seen in similar period in any previous year. Prices on an average declined by 7.5% QOQ, while exit prices in March were lower by 9 to 10% compared to Q3 average. Generally, Q1 sees a price increase across the markets. However, we have not seen it so far. I believe that the prices may remain soft in the first 2 quarters, and price increase, if any, may happen from Q3 this year onwards. During Q4, to regain market share, we have incurred some incremental costs, some of which we believe would be corrected over the next few quarters. Dharmender will take you through the details in his opening remarks. Coming to the outlook for the sector, I continue to believe in the India growth story, and we believe that we will continue to see the GDP growth upward of 7% in the coming years. Since cement would play an important role in the India growth story, led by all-round infrastructure development, housing and private capex, I believe that the cement demand should grow between 8.5% to 9%. I believe that we can deliver a volume growth of 1.5 times of the sector, excluding sales from the JP assets. The additional volumes from JP should give us an incremental 4 to 5% growth on an overall basis. During the year, financial year 24, we have added 6 million tons of cement capacity and reached closing capacity of 44.6 million tons. Our 1 million ton expansion at both Ariyalur and Kadapa is under trial run production. We have also added 0.9 million tons of clinker capacity in South during the year. The JP transaction has taken longer than we anticipated, but it is progressing in the right direction. As you all must have read in the papers, NARCL has put in a bid to buy the entire debt of JP, and it is under evaluation by the current lenders. We understand that the lenders are keen to create lending capacity on their balance sheet by transferring this debt to NARCL, but there are procedural delays which are beyond our control, and the transaction closure may get pushed out to Q2 of this year. We continue to establish our brand and distribution in MP and UP through the tolling arrangement with JP. In Q4, we sold 0.6 million tons from JP, and in financial year 24, we sold 1.4 million tons through this tolling arrangement. Some questions were raised regarding our limestone reserves. We have already clarified that we have sufficient reserves, and there have been some gaps in the information that resides in the public domain, which is in the process of getting corrected. For example, in case of our Murli plant, the updated records now show that our limestone reserves are up from 3 years to 22 years. We are very excited about the promise that this sector holds. We remain convinced about the structural trends that support secular demand growth, rising entry barriers, and further consolidation in the sector. While prices may remain under pressure, we will continue to invest in our brand, deepen our cost leadership, and focus on organization building. Now I will request Dharminder to take you through the detailed financial performance for the year and the quarter gone by. Thank you.
Thank you, Punitji. Good morning, everyone. Let me take you through the key aspects of our performance. During the quarter, we delivered a healthy volume growth of 18.5% YOY and sold 8.8 million tons. On a full year basis, our volume growth was 11.8% YOY and sales volume was 28.8 million tons. Our overall trade mix has improved to 65% during the year from 63% last year. Our revenues during the quarter increased by 10% YOY to rupees 4,307 crores and full year by 8.4% YOY to rupees 14,691 crores. However, NSR declined 7.5% QOQ to rupees 4,891 in Q4 as prices declined in our key operating markets. During the year, we launched a new brand campaign, RCF Strong to Ghar Strong, and repositioned Dalmia as roof, column, foundation expert, that is RCF expert. We have invested about rupees 70 crores during the quarter in marketing, which is an increase of about rupees 30 crore on a QOQ basis. Our raw material costs during the quarter has increased by 4% YOY to rupees 771 per ton of cement production, with about 2 to 6% increase in slag and fly ash costs. If you add purchase of stock and trade goods under tolling arrangement with JP Group, the increase in the financials would appear much higher, as our volumes from JP plants are increasing quarter upon quarter. Power and fuel cost declined 21% YOY to rupees 1,018 per ton of cement, mainly due to $48 decline in the fuel consumption cost on a YOY basis. With this, our blended fuel cost during the quarter stands at rupees 1.45 per kcal. Besides the correction in fuel prices, our efficiency parameters like usage of renewable power improved to 27% from 21% in FY23. Bring about more predictability and sustainability in our costs. We'll continue to invest in renewable power and operationalize our own coal mines during the year. During the quarter, in order to regain market share, we have incurred additional logistic costs, and as a result of which, our logistic cost increased by 4.7% YOY to rupees 1,158 per ton. We believe that a large part of this increase will be corrected in the coming quarters. During the quarter, our finished WIP and stock in trade inventory declined by rupees 137 crores. This also led to increase in cost of goods sold by about rupees 40 per ton, as the fixed overheads which are inventorized came as a charge to P&L. This will reverse in coming 2 quarters when inventory levels rise, and on a full year basis, such effects get neutralized, with most of the charge coming in Q4. Other expenses like sales commission, depot-related expenses, coupled with increase in repair costs, material handling and packing expenses have increased by rupees 92 crores on a YOY basis due to higher volumes. Overall, our EBITDA during the quarter declined by 7.8% YOY to rupees 654 crores, which translates to an EBITDA of rupees 743 per ton. On a full year basis, EBITDA increased by 13.4% YOY to rupees 2,639 crores with rupees 917 per ton of EBITDA. On incentives, we accrued rupees 93 crores during the year or during the quarter and collected rupees 98 crores. On a full year basis, our accrual and collections are also largely the same. Accruals were about rupees 298 crores, while collection has been 314 crores, with closing outstanding of rupees 701 crores. For financial year 25, we expect the total incentive accruals to be around 300 crores. The other income during the quarter has increased by rupees 82 crores on YOY basis to rupees 120 crores, primarily due to higher treasury income coupled with increase in dividend income by rupees 14 crores, receipt of interest subvention incentive income of rupees 22 crores, about rupees 11 crores interest on income tax refunds for earlier years, and realization of insurance claims of rupees 9 crores. During the quarter, we have reviewed our accounting policies and practices with leading industry players and made changes in few of these to align with industry practices. Due to this, certain line items in the reported financials for previous years has also been restated. While we have made the appropriate disclosures in the results released yesterday, let me briefly take you through these changes. First is, we have reevaluated the economic benefits derived from property, plant and equipment of our Northeast units and decided to change the method of providing depreciation on PPE from written down value method to straight line method, with effect from 1st January 2024. Now we are providing depreciation on SLM method across the company. Further, we have also reassessed the salvage value of the building and other plant and equipments from 1% to 5% of the cost, with effect from 1st January 24. Consequent to both these changes, the depreciation during the quarter was lower by rupees 46 crores and rupees 14 crores respectively. Secondly, the classification of unwinding of income on interest-free loan from state government has now been reclassified to other operating income from other income. Consequently, our revenue from operations has now been restated. The impact of reclassification is included in our financial reports. With above changes, the depreciation during the quarter declined by rupees 8 crores on a YOY basis. However, it has increased by rupees 193 crores for financial year 24 when compared to financial year 23. Of this increase, rupees 108 crore pertains to components of plant and equipment which were and are being replaced as part of our overall debottlenecking projects. We expect depreciation to be in the range of 1,350 to 1,400 crores in FY25, excluding the impact of JP plants depreciation. Our profit after tax for the company stands at rupees 853 crores during the year against rupees 1079 crores in FY23. If you recall, we had a gain of rupees 554 crores in share of profit in associate, rupees 125 crores tax thereon, and rupees 144 crore loss in exceptional items last year, which was primarily due to the recognition of sale of our refractory business. Same is not there in the current year or current quarter. Our planned capacity expansion at Kadapa and Ariyalur for 1 million ton each is under trial run and will be commissioned in the current quarter. We are also progressing well on 0.5 million ton expansion in Rohtak and 2.4 million ton in Lanka, Northeast, which is expected to come on stream by end of FY25. Considering all organic and the proposed JP acquisition, we are likely to close this year at 58.9 million tons of cement capacity. The capital expenditure during the full year FY24 was rupees 2,827 crores against our expectations of 3,000 crores. We expect capex spending of about 3,500 to 4,000 crores of capex in FY25, which will largely include spends towards Northeast expansion project, Rohtak cement plant in Bihar, and also certain ROI and maintenance capexes. This will be besides the outflow of for JP assets, which is expected to be around 3,500 crores for 5.2 million tons cement capacity of Rewa, Chur, Chunar and Sadwa, and 2.2 million tons for JPSCL assets With this capex, we expect our peak gross debt to be about 9,000 crores and net debt of about 5,000 to 5,250 crores by year end. As of 31st March, our gross debt has increased by 887 crores and the closing debt stood at rupees 4,651 crores. At the same time, our net debt declined to rupees 484 crores, resulting in a net debt to EBITDA of 0.18 times as of 31st March. Lastly, in line with the capital allocation framework, the board has proposed a final dividend of rupees 5 per share, which is subject to the approval of the shareholders in the ensuing AGM. This is in addition to the interim dividend of rupees 4 per share. The total dividend declared for the year, including interim, is rupees 9 per share. With this, I now open the floor for question and answers. Thank you very much.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi, sir. Am I audible?
Yes, please.
Yeah. Sir, I had two questions. First was on JP. How much money did we make on a per ton basis on the tolling that we did, 0.6 million tons for the quarter and for the fiscal? That's one bookkeeping. And second question is, will it be possible for you to actually bifurcate the entire 9.4 million ton? So we understand that 5.2 million ton part of the kitty is pretty much clear. So how should we look at it? So you indicated Rewa, Chunar, Chiruk is one. Then there's the Bhilai facility which is there. So what is the sort of clarity that we have on this particular asset, again, when it comes to procurement of the clinker? Likewise on Nigri and lastly on Super Dadla. So if you could please provide some clarity from a legal aspect as well as the process. I understand timelines could be tough, but would be interested to know the process, sir.
I think on the Rewa package, we have already said that this requires NOC from the banks. The banks are, we understand that they are trying to sell their loan to NARCIL so that we don't have to deal with 35 banks to get an NOC, but it is only from one person who holds the loan. I think this process is undergoing and progressing quite well. Although there are some procedural delays, and we expect that this should get consummated in the second quarter of this year. As regards the sale package, this requires sale to take a view as to whether they are a joint venture partner, whether they want to buy, hold or sell. So they have a right of first refusal. So either they can buy the shares or they can sell the shares to us or they can continue to remain a joint venture partner. So I think SAIL is still evaluating the proposal, and I think again, once SAIL has evaluated the proposal, they will come back to us. I think this is the legal process in both the packages. Dharmendra, you want to add anything?
As a capacity breakup, this 5.2 million is one consolidated transaction, Rewa, Chunar, Sadhwa. So all of this comes together. And the second separate transaction is Nigri plus PJCL, which has 4.2 million of cement and 1.1 million of clinker.
Right. Sir, thank you for your answer. Sir, you indicated that the lenders, we need a NOC over there. Who's the lead indicator or who's the lead banker over here? Have the banks already approved it, or the consortium still needs to approve the bid? And is there scope or some probability for a re-auction over here, or should we assume that we should rule it out?
I think, until the company goes into NCLT, there is no, banks are not driving the process. This sale process is being driven by the JP board, and the JP shareholders have to approve it. and the JP shareholders have already approved the transaction. Board has already approved the transaction. We already have CCI approval for the transaction, and all we need is the bank's NOC, because the company is in default of the loans.
Okay. Lastly, JP profitability on the tolling volumes?
So on profitability, we would not like to share currently.
We don't share regional breakup of profitability.
No worries. Thank you so much, sir. I'll join back with you. Thank you.
Thank you. The next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Hi, sir. Good morning. My first question is on the this Super Dalla. What is the status on the same? And then a few housekeeping questions vis-a-vis trade, non-trade, and the other blended cement and all, which I'll come back.
So, as we've said earlier, also Super Dalla, JP is in arbitration with Ultratech, and I think our transaction is subject to the outcome of that arbitration. So that arbitration is going on right now. And, till we know the outcome of that arbitration, I think, this deal cannot be done till the arbitration is concluded.
Okay, and this 3,500 crore which you're, targeting for the acquisition, that is only for the phase 1 acquisition, or that includes even the 4.2 million ton?
It includes BJCL sale also, and Nigri will be on long-term lease.
Okay. And coming to these housekeeping questions, what was the blended cement trade share and premium share in this quarter?
The trade sales was 65% for this quarter. Premium products was 21%, and the blended sale for this period is 87%.
And sir, green power share and fuel mix?
The green power for this quarter is 28%, and fuel mix, petcoke is about 56%. Beyond that, we don't share.
No, sure. And CC ratio?
CC ratio for the quarter is 1.67.
Okay. Sir, one last question. In this quarter, we have seen very strong volumes, but the margins have taken a significant beating. So what is the outlook in terms of these margins? Whenever we see targeting 1.5x industry growth, so will that growth come at a significant lower margins, or 1,000 rupee odd EBITDA margin which the company has historically delivered? That is not a pipe dream or a distant dream for the place like you and for the industry in general. Should we be factoring decent margins when we are targeting strong volumes?
So basically, as you also heard from Puneetji and in my opening remarks, that this additional cost also entails some of the incremental costs on the logistic, on the branding, and some of these other things. So a couple of these things will definitely be reversible. They'll get neutralized or corrected in the next couple of quarters. So we expect this margins recovery to happen. But of course, the selling prices also play an important part, which we expect that in the first 2 quarters they may remain soft. And once third or fourth quarter, once the prices improve, definitely the profitability margins will be healthier.
Okay. Great, sir. Thank you. I'll come back in queue.
Thank you.
Thank you. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Just first on the depreciation, change in depreciation policy. I know back about 4-5 years ago, the company had changed the depreciation policy to WDV for Northeast assets. So what is leading to all these changes? What was the rationale back at that time to change to WDV, given you were an outlier at that time?
Yes, Satyadeep, you are right. The earlier change when we did, at that time, we had benchmarked the Northeast plants to the Northeastern players like Star and other players in Northeast. Most of them do a WDV method of depreciation. But currently now when we have realigned it, we have realigned to the national players or leading players. Most of them, they have SLM method. So the entire company now we have moved to the SLM method.
Okay. Just on the other expenses, you mentioned about 30 crore is reversible. Is that right from the current quarter? Because other expenses did increase.
When I said the 30 crore has increased, and we also continue to focus on our branding and activities. So this 30 crore may not reverse soon. In the current year, the focus on branding will remain. But the other things which I said, the inventory depletion had an impact of about rupees 40 per ton overheads getting charged off. That is reversible because first 2 quarters inventory builds up, and the other there will be negative charge of fixed assets, fixed overheads. And the increase in cost on account of logistic or depot expenses or sales commission, etc., which went up in the quarter 4, these will normalize in the coming quarters. And also, there's one more thing. The logistic cost also is going to normalize. So these things will happen, which will be taking it to normal positions.
Okay, fair. Just one clarification. Just one question on the timeline for the medium-term capacity expansion that you had outlined. When are you thinking of putting it up?
We are still debating that within our management team and our board. I think we will take a few more quarters before we can come back to you with a plan for the further expansion.
Okay. Thank you so much. Wish you all the best.
Thank you. The next question is from the line of Nikunj Mandowara from UBS Securities. Please go ahead.
Hey, hi. Thanks for the opportunity. So just wanted to get more color on how do we see the volume growth year over year for the next year, and we are seeing 8.5 to 9%, but how do we see this playing out quarter-wise? Because I expect H2 will have to do the heavy lifting in the volume growth here. And so secondly, related to this, what is giving us confidence that pricing should bounce back in H2? Because if I look, I think there is a lot of fresh capacity which is going to come in H2 by Ultratech, by Shree, and even if the JP acquisition is completed, then even for us. So what is giving us confidence that pricing should bounce back in H2? Thanks.
No, I think nobody can forecast, prices. All I said was that I don't see any strong momentum in the market right now. And if at all, the prices correct, they will correct in H2 because first quarter is the election year. The first quarter is election, second quarter is monsoons. And if at all there's some recovery, it's likely to happen post the monsoon quarter and the election quarter.
Okay, sir. Thank you. And so on the volume growth question?
So I think we have said that, we think we can grow at 1.5 times the industry, and JP assets can further add 4 to 5 percentage points in terms of volume growth. So I think it's hard for us to give quarter by quarter forecast on, volumes, but I think we are giving a general guidance on, how we think we can grow on a, sustainable basis.
Okay. Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, thank you for the opportunity. Sir, I have a question which is more on a strategy or medium-term viewpoint, not just on this quarter. So what role does operating leverage play in our business? We understand the fixed cost, variable cost is one part, which is maybe power and fuel, freight, etc. But even after such strong volume growth, we have not really seen the benefits of operating leverage in the last few quarters. So going ahead, where do we think we can really beat the street on cost, particularly not on volume growth, but on fixed cost recovery?
See, the fixed costs have been created for a much larger capacity in the coming years. So when we envisaged that we'll be growing capacity to about, let's say, 75 million tons. But anyway, so even the medium-term plan for the next year is about, let's say, close to 58, 59. So the costs have largely been created, and now I think as we improve the capacity utilizations, so this operating leverage will definitely come into picture.
So going ahead, sorry, please.
However, having said that, I think we will invest some amount of it into brand building. So part of it will come as an expense on our P&L, but, we think it's a long-term investment, and it will help us, in the longer run with, better margins. So I think Some of it will show up as operating leverage as fixed cost gets amortized over a higher volume as we utilize our capacity. But part of that we will reinvest back into building our brand.
When you say brand building, is it more of advertisement or more of dealer incentive and dealer discounting? How should we look at it?
So it is mainly the brand as well as the activities which you do around the dealer shops, marketing activities, technical services activities, customer relationship management activities, not the discounts. Because once the marketing spend and brand strength improves, discounts will go down. You don't require discounts to push up your sales volume. So that is the idea, that there should be demand pull through brand, higher, better strength of the brand, rather than need to push sales through discounts.
Sure. Thank you. And my last question is on power and fuel. Any further reduction expected, in the sense, what is the spot cost versus what we have booked in fourth quarter?
So basically, the next quarter you can expect another reduction about 1-2%, because petcoke prices have largely stabilized in the last couple of months, and the first quarter rates are already contracted. So you can expect about 2% drop from the current quarter level.
Sure. Thank you for your answer.
Thank you. Thank you, sir. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Good morning, and thank you for the chance. First question is it possible to give the breakup of JPA and organic volumes in fourth quarter? And want to understand basically on a year-on-year basis how much X of JPA has the volume grown?
So out of 8.8 million total sales, 0.6 is on account of JP and rest is on account of our existing plants volumes. So to X of JP, I think the growth is about 12%.
Okay, and last year, fourth quarter, it was what, 0.1 or something, JPA volumes?
That was, 0.1.
0.21, okay. Got it.
0.1. Yeah, 0.1. Last year this quarter was about 90,000 or so.
Okay, got that. Just from a strategy point of view, if you look at FY24, few quarters we've lost volumes. Now we've regained volumes at the cost of margins, which is not, this kind of a volatility in performance is not there with peers, right? So, from an FY25 point of view, how should we look? For the management, what is the priority? Is it earnings? Is it market share volumes or margins? Some thought process if you could share.
Our thrust on the market share regaining will continue, but of course, it will, as I said, our cost which got increased in Q4 will get normalized. So the quality of sales also will improve, but definitely the volume improvement will remain the number one priority.
Okay. And directionally, is it possible to share? The contribution from tolling. Is it a negative contribution? And just to penetrate new markets, are we doing the sacrifice till we get these assets under our umbrella? Just directionally, is it possible to share how the margins or contribution is comparing versus organic volumes?
The current will not like to share the separate profitability of JP operations, but you can expect that we'll bring these plants to our normal cost structure of Dalmia in about 2 years. So in the third year, we can expect similar profitability as we get in the rest of the group. And for 2 years to gradually improve the profitability.
Okay, got it. And just one last thing on the prices in the opening remarks, did we confirm that we've not seen any price increase in East and South in our core markets in the month of April? Because there are a lot of reports suggesting an attempt of a big hike. But can you just share what's been the on-ground situation in the last few weeks?
Yes, in the April month also we have not seen any improvement. So we are close to the exit levels of March, which is about 9 to 10% lower than the Q3 levels.
Okay, and what would be this exit level versus 4Q average?
And about Q4 compared to Q4 average, it will be about 2% lower.
2% lower.
Exit levels. Exit.
Got it. All right. Thank you and all the best.
Thank you.
Thank you. We'll take the next question from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
So thank you for taking my questions. Most answered. One question, I mean, you yourself said in your opening remarks that this is unprecedented in terms of the price action that you have seen. Could you highlight why these kind of price correction happened? Is it just because in a pre-election period everybody wanted to get to volumes, which is why price wasn't a consideration? And if you could also get a sense of why this should change, given everybody is adding capacity, because it's pretty worrisome in terms of the way price action had happened in the sector in this quarter.
I think as I said, it is hard to forecast prices in a commodity business, and we personally think that in the next 2 quarters, this is an election quarter, and the next quarter is a monsoon quarter. So I think it will be hard for us to believe that there will be a significant upswing in prices. Although I think there will be, everybody will, report some margin drop, how much, etc., needs to be watched. So it's hard to predict by when and how much prices will rise. And while capacity addition continues, I think the rate of capacity addition is lower than the rate of demand growth. So utilization levels should go up gradually. I think that is what we are seeing. However, there is excess capacity in the industry. That's a reality. And, as long as there is new capacity addition and there is a quest for higher growth, prices could be under pressure. Having said this, we have seen this industry, it goes through, ups and downs in terms of margins. We still believe that, there is a structural trend of, higher consolidation, and there is there are rising entry barriers. So even if, let us say, margins are under pressure, it may enhance and accelerate consolidation as well. So I think it's hard to forecast prices on a quarter-on-quarter basis, but all I can say is that we remain convinced about our investment thesis in this sector, and rising consolidation is a trend that we continue to see. We are already seeing 3 transactions which are in the works. Ultratech is buying Kesoram, Ambuja is buying Sanghi, and our transaction with GAP is under process. These 3 are large transactions. There are some small transactions which were announced recently in terms of grinding units, which were bought by Ultratech and Ambuja. Ambuja bought My Home Cement grinding unit in Tamil Nadu, and Ultratech bought the Parli cement unit of India Cement in Maharashtra. So I think the trend for consolidation will continue, and over a medium term, margin should normalize in my view.
Sure, we are hoping for the same, sir. Thank you.
Thank you. We'll take the next question from the line of Mohit Jain from Tara Capital Partners. Please go ahead.
Hello. Can you hear me?
Yeah.
Sir, your audio.
Yeah, hi.
Sir, it's not that clear. May I request you to kindly use your handset, please?
Yeah, hi. Can you hear me now?
Yes, sir. Please proceed.
Yeah. So just wanted to have a view on the expansion plan. You said that the board is looking into it and maybe a couple of quarters will come with it. So having said that, is it likely that the 75 million tons target of FY27 is likely to be pushed back, because I think the ordering has to start soon if we want to achieve that timeline? So how do you look at that, sir?
I think, we will comment on this over the next few quarters. As I said, we are working on it with the management and with the board. And I think, we will share with you whenever we are ready.
Okay, thank you.
Thank you. We'll take the next question from the line of Rahul Gupta from Morgan Stanley. Please go ahead.
Yeah, hello.
Yes, sir, please proceed.
Thank you for taking my question. I'm sorry to ask a similar question like other participants, but in a different way. So this question is for Puneet. Puneet, you have been bullish on medium-term India story for some time, and hence demand for cement will remain strong over medium to longer term, right? But given seasonally next couple of quarters is going to be weak for the industry, what is the risk of demand not improving in second half or getting pushed out to next year? That's it. Thank you.
Look, it's hard for me to forecast demand on a quarter-on-quarter basis. But, I think if GDP growth continues at, 6.5-7%, we think that this is a phase of India where it is infrastructure-led growth. And the cement demand is likely to be 1.2, 1.25 times GDP growth. So if GDP growth gets, hit on account of geopolitical factors, which as of now it seems that India is reasonably insulated, other than that, I don't think that the structural demand story is under pressure in any way. But quarter on quarter, sometimes things, get pushed out. But we've seen that even if there is 1 year of lower demand growth, next year it catches up. Projects sometimes get pushed on the ground for a few quarters, but, they don't get completely abandoned. So I think it's hard for me to forecast quarter on quarter, and I think it's, the structural demand story is, quite strong. But if there is any shock on, macro global shock on which impacts GDP growth, then I think, it may impact cement demand as well.
Thank you. The next question is from the line of Naveen Sahadev from ICICI Securities. Please go ahead.
Yeah, am I audible?
Yes, sir. Please proceed.
Right. So thank you for the opportunity. Puneetji, just in the previous question comment, you mentioned that there is consolidation on the rise. More recently, there have been a couple of grinding units, especially let's look at, let's say, My Home, who sold a Tuticorin unit. While consolidation is definitely a good thing, but should not one look at it this way, that these promoters look at prices being bad in these markets for a slightly more prolonged period of time, and hence they are giving up on these assets rather than keep incurring losses or not really operating these utilized or units to the fullest. So is that not an indication of a prolonged price weakness also when these companies are looking at sales of grinding units?
I think, they still have all their assets in these markets. So if it was a decision which was driven by a prolonged price, a view of prolonged price pain and, structurally lower margins, then, they should divest more assets rather than, a few assets. Because, all their assets are in these markets only.
Fair point.
It is more driven by some maybe, need to improve the balance sheet strength as opposed to, a long-term view of structural weakness in the market.
Helpful. So second question was on the non-trade segment, both for us and the industry. So is it safe to say that at Dalmia in March quarter, our exposure towards non-trade would have gone up and hence a slightly more amplified impact on realizations? That's just one part of the question. The second is in the same breath. At a broader industry level, do you see demand in general tilting or shifting towards non-trade segment, and hence industries or industry as a whole and companies are increasing their exposure towards non-trade, where the price gap, I think, has gone up materially? Thank you.
So in the last quarter, our non-trade sales has gone down. In fact, the trade percentage has gone from 63 to 65. So that means there's a 2% drop in the non-trade sales. However, our focus continues to be to build a good brand and also to gain further improvement in the trade share. But definitely non-trade being a significant portion of the total market, that cannot be neglected. So gradually we'll keep improving the trade, but also keep using the non-trade segment for utilization of our capacities. And in some of the markets, as you rightly said, the prices have improved, so prices and profitability is similar as we are in the trade segment.
That's great. Just that at a broader industry level, some color or some thoughts if the exposure to non-trade, I mean, while it's great to know that in a quarter like March when everybody was focusing on volumes, Dalmia did a commendable job of trade going up, in fact, from 63 to 65. But at an industry level, are you seeing some change that non-trade as a segment is getting more share now? Thanks.
Overall, of course, since the demand in the urban areas or the RMC sector is leading to a slight increase in the non-trade segment, including the infra spending of the government. However, all the big players, I think they continue to focus on their brand strength and also on the trade segment. But there are some other players which cater to the non-trade segment, so their share in the non-trade may be going up. But overall industry level, yes, the non-trade segment continues to be strong.
Thank you, sir. We'll take the next question from the line of Jashandeep Singh Chadha from Nomura. Please go ahead.
Hi, thank you for the opportunity. I hope I am audible.
Yes, sir, you're audible.
Yeah. So coming to, Dalmia, firstly, I would like to understand, given that this quarter, your volume growth from the core assets has been around 11 to 12%. So is South accounting for the, majority of the growth? And if yes, how much market share gain you would have in South? And also, for a couple of quarters now, we are seeing that whatever the reduction or increase in realization has been there, the EBITDA per ton follows that. So there is no question from the, cost saving. So is it, safe to say that Dalmia has reached its lowest cost? And if not, what is the delta you see for the next coming year? And from where, these cost savings will be coming? This is my first question.
See, we don't give the regional breakup of the market shares or the profitability, etc. So that I'd not like to comment. But we have not reached the lowest level of the cost, what we plan. We are amongst the lowest cost players in the industry, but there is further room to improve the costs in terms of the RE power will continue to increase. The coal mines which will be starting in the current year, that will bring down our costs. Then, of course, there will be a lot of ROI projects and logistic cost. We see a lot of room to improve in terms of cost, both in terms of lead distance as well as the right mix of the usage of the rail and road. So, sequentially, directionally, the cost will continue to drive, and we continue to aim to be the lowest cost producer in the industry.
Just thank you for this, sir. Just to follow up on this, if you can directionally, provide us that was South doing better than East, just a directional thing. And second on cost, I see, you have earlier planned to have 130 million ton, 130 megawatt of solar, but you ended up just at 113 megawatt, if I'm not wrong, this quarter. So what was the, what was the reason for the delay? And second, what was the lead distance for this quarter? Because your logistical cost also you were saying has increased. So how much sequentially the, your lead distance has increased?
So lead distance for the current quarter is 289, which is an increase of 2 kilometers from the last quarter. And directionally, we would not like to comment on the regional profitability. And in terms of the RE power, see, the delay was when we are noticing the negotiations of this RE power projects. We saw that technological changes are also coming to play, and that was driving the cost down. So instead of contracting earlier, rather we waited, and ultimately whatever orders we have finalized, they are much, much lower compared to what we would have contracted earlier. So maybe there was a saving of about 60 paisa per unit kind of thing had we contracted it 6 months earlier. So currently we are at around 185 megawatt RE power capacity. We expect that by the end of the FY25, we'll be touching about 350 or so, and again go up significantly in the FY26, for which we'll give you exact volumes or exact capacities in subsequent quarters.
Okay. Thank you, sir. And my next question is on JP. So we have seen, historically, whenever a company is under NPA and an asset construction company overtake that, so normally that overrides any management decision. So in light of that, how confident you are that the binding agreement that you have signed with the management will stay? And also, even if it stays, you have not, if I'm not wrong, you have not signed binding agreement for the complete 9.2 million ton. So once NARCL comes in the picture, how confident you are of acquiring complete asset, because this will also lure your peers to make bids for the remaining assets.
See, lenders assume control of the company when the matter is referred to NCLT, not under the normal transfer of the debt to NARCL. Because NARCL remains as a lender compared to, let's say, the current set of 35 lenders. So management controls and decision-making remains with the company and its board, so that doesn't change. And in terms of the binding agreements, the binding agreements are already signed for this 5.2 million capacity of Rewa Chunar, plus this 2.2 million of BGCL, which is sale JV. And the understanding is clear for the 2 million also, that it will be on a 7 years lease, and within that period we can always buy. And this is, of course, linked to the BGCL. So as and when we get this closure, that can be signed immediately and implemented. That is not stuck for any other reason.
I just want to add to this that the JP board and the shareholders have already approved the transaction.
There is a binding agreement for that.
Thank you for the explanation, sir. I'll join back the queue.
Thank you. We'll take the next question from the line of Darshan Mehta from Axis Capital. Please go ahead.
Yeah, sir. Sir, thanks for taking my question. Sir, I'm sorry I'm repeating, but sir, since you alluded to the fact that we have elections around the corner and hence it would be difficult for us to take price increase. But sir, is this regard, if we see the last general election, I'm talking about April to May 19, while the industry volumes were muted, it was able to take fair amount of price increase. So what is it that is different this time? And my second question is, while you said that we have not seen any price increase in April, is it for Dalmia, or we can say the industry itself has not seen any price increase in April, especially in South and East? Yeah, that is.
I think the price decline is not just for Dalmia, but it is for the whole industry. As regards, whether price increases can happen in the election quarter, the answer is that yes, it can happen. However, I think given the momentum that we are seeing in April, we feel that, the price increases are unlikely to come through this quarter. That's what we feel. But again, who knows? Hard to forecast, how things will behave.
Thank you. Thanks.
Thank you. We'll take the next question from the line of Rashi Chopra from Citigroup. Please go ahead.
Thank you. Just on the margins, in the last call you had indicated that, the EBITDA per ton for the next year or so should stabilize at about 11 to 1200. And given where, what has come through in the fourth quarter and given where prices are, that looks a little bit sort of stretched at this point. And Puneet, you also indicated that margins should stabilize in a few quarters or so in the medium term. So when we are talking about stabilizing and we're talking about the near term, are you suggesting that at 11-1200 is no longer the normal and it should likely be lower? That's my first question.
No, I think, as I said that, there has been an unprecedented price drop during this quarter. And I think it is for the whole industry. As far as Dalmia is concerned, there were some incremental costs that we incurred this quarter in our quest to gain market share. Some of those costs are going to get corrected. They are one-offs and they will get corrected over the next few quarters. And some of them will continue because we will invest in marketing and building our brand. But having said that, I think, there will be price volatility, and if if the prices remain subdued, the margins can then only come from cost control. So I think our focus will continue to tighten costs further. Our focus will be to invest in our brand and invest in distribution and improve our utilization and gain market share. But as far as the overall pricing environment goes, we will swing with the industry. And I think as our brand gets stronger, as our distribution gets stronger in the new markets that we are entering, I think we should be able to reposition Dalmia in some markets where we are weak in terms of our pricing compared to our competitors. And even if price goes down, part of that can be hedged by improving our brand mix and improving our price positioning in some markets.
Okay, thanks. Are you able to quantify the one-off costs in this quarter, as in what kind of a reversal can we see going forward?
Yeah, as Rashi, as I explained earlier in the call, that this inventory depletion in the current quarter, which was 137 crores. So this embeds the fixed overheads, which also get charged off. So that should, when this gets normalized, it's improvement of 40 rupees. And the cost for second quarter, rather, when the inventory gets built, it will be saving in the fixed cost portion. Besides that, the increase in the logistic cost, we expect that this is going to be normalized in the next 2 or 3 quarters itself. And fixed cost overheads increase in terms of the marketing will continue. We will continue to spend. And the other expenses like commission or depot expenses also, there also I think we expect some savings will come in the coming quarters. And as we ramp up the JP operations, there also we should improve.
Got it. So, okay. And so the logistics cost quantum would be how much?
It was 70 rupees increase in the current quarter.
So that the whole thing you're saying should?
Majority of this.
Okay. Another point was, I think you mentioned that, as the marketing spends increase, the idea is essentially to build brand, and that's how the volume push happens, and dealer discounts don't really need to be hiked. Was that the same situation in this quarter, i.e. that, the kind of realization pain that you have seen that should be felt by competition as well? Or, or did you have to kind of increase dealer discounts to be able to get these volumes?
Over the year, we have been able to reduce the discounts marginally, but we see more scope. As we spend more on the branding, we see more scope to reduce the discounts.
And I think overall the realization of competitors will depend on their market mix and their brand mix and their trade segment, trade and non-trade mix as well. So I think let's see. We are the first ones to declare results. I think over the next 30 days, we should get more visibility on this.
Got it. Thank you. Just one last housekeeping question. What was your consumption cost of fuel on a per kcal basis?
Yeah, 1 rupees 45 paisa.
Okay. Thank you.
Thank you. The next question is from the line of Aman Agrawal from Equirus Securities. Please go ahead.
Yes, sir. Thank you for the opportunity. So I just wanted to understand on the captive coal mine that you have mentioned in the presentation. So what kind of output are you looking out of this, and maybe what kind of share would this mine be able to meet of our overall coal requirement, and the cost that you expect per kcal, maybe if you can share such details.
Okay, the specifics I'll not be able to share, but it is the Jharkhand mine Binda Sasai which we had got, so that will get operationalized in the current year. And the next year, Mandla coal block also will get operationalized. Mandla will not come into operation this year. So this Binda Sasai will cater to part of our requirement in the east and will definitely bring down the cost significantly. But exact specifics I would not like to share right now.
Understood, sir. Understood. And just lastly, if you can, sorry for the repetition, but if you can share the peak debt numbers and maybe the expected depreciation number that you shared earlier.
Yes, please. So depreciation we expect to be about 1350 to 1400 crores for the coming year. This is without JP assets. And peak debt to be about around 9,000 crores and net debt around 5,000 crores or so by end of the year.
Thank you for the answers.
Thank you. We'll take the next question from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good morning. Sir, I had a couple of, basic questions. Like on tolling, when we send the clinker, that is not recorded as a sale in our case. Is that right? Or we are recording both clinker and cement sale as volumes?
Only when cement is purchased by us from JP, it is recorded as a purchase of stock and trade, and when it is sold, it is coming in the sales. So movement of clinker from Rewa to Chunar, it is within the JP system, so that is not recognized as purchase by us.
Okay, got it. So secondly, the freight cost increase that you spoke about quarter on quarter, can you give some more color on that? Like, was it a factor of regional mix, or what was the main reason for that?
Yeah, multiple factors are there, including the movement of the clinker, from increase in the 2 kilometer increase in the lead distance, some PTPK increases. Many of these things will number. And regional mix also is important in this.
Okay. And lastly, this question is for Puneet. So Puneet, in the last, say, 3-4 years, we have, spoken a lot about growth and a certain long-term number. But in terms of execution, we have clearly been behind the curve. Like, we also expected JPA to come through much sooner. Now it has seen delays. And, September also, I guess, is more a hope at this moment rather than a high conviction timeline. And, even on the organic expansion now, like you highlighted earlier in the call, that we are revisiting at a board level. So what has really changed? Because we were clearly very aggressive in terms of our long-term volume targets and all. And now there seems to be a lot of two-step forward, one-step backward kind of thing. So what has really changed in our thought process, or is it something else, which we should be aware of?
I think the long-term story is still intact. I think there have been, some delays in the JP acquisition, for sure. And I personally also think that I still remain convinced that it is progressing in the right direction. I think no question about the fact that, we were quite confident in the last call that the transaction should get consummated before March, but it didn't happen. So there is a procedural delay. And I think, whenever you do an acquisition like this, it is the company is under stress from because it is defaulted. So it sometimes takes longer than you expect, but it is also giving us time to establish ourselves in the region. So there is a lead time that we get to establish distribution, brand, and volume in that region. So I would say that yes, some of the things don't pan out as you expect, but that's a part of life. And I think overall we are quite happy that we have grown to 50 million tons or close to 50 million tons without adding any debt on our balance sheet. I think that's a very impressive achievement in the last 3.5 years. We've doubled our capacity without adding debt on our balance sheet. There has been some up and down with respect to our volume growth and our market share. But I think we did try some experiments which didn't work. We have learned very quickly. We have demonstrated our ability to regain market share in 2 quarters itself. And I think the cost is not fully optimized yet, and that's okay. We will optimize costs as we go along in the coming year. And I think we just want to make sure that we think through our next phase of expansion and announce it when we are ready. And as I said, I remain highly convinced about the fact that there will be more consolidation, entry barriers are rising, and demand growth will continue in the sector.
Actually, that's a long-term
story. In a long-term story, couple of quarters here there makes is something that we have to be prepared for, and we can adjust for. But I think overall, in terms of capacity growth, I'm pretty impressed with what we've done in the last 3 years.
No. So if I can just ask one follow-up. So, the reason. So one thing is, when you come back, let's say in 2 or 3 quarters after discussing internally and with the and all. Will the 75 million ton by 2027 number can change materially? If you can give some thought on that. And secondly, I
will let you know once we've discussed it internally, and we will make the announcement when we are ready.
Okay, got it. Thank you so much.
Thank you. Ladies and gentlemen, we will be taking only two last questions from the participants now. And the next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you, sir. Sir, continuing the previous question, so let's say even if we, as you mentioned, even if we decide to take a couple of quarters to decide for a 75 MTPA, let's say 3 quarters down the line, even if you say we want to reach to a 75, then also is it possible to reach 75 million ton by FY27, because then you have only 2 year and 3 months. So is it possible even if we decide 3 quarters down the line, can we reach 75 million ton by FY27?
I think, greenfield projects may take 2.5 years. We are seeing it in our Northeast project. It will take probably 2 years and 3 months to commission. So I think, commissioning new projects in this timeline is not difficult based on our own execution track record and what we are seeing recently. The other thing is that, there could be possibilities of inorganic growth also. That could get done faster. So I think 2.5 years is still a reasonably good time for us to expand.
Okay. Second, sir, when we say that we expect 8.5 to 9% kind of a demand growth in FY25, and we want to grow at 1.5 times of the industry growth, so that comes closer to a kind of a 12.75 or 13%, versus last quarter we were saying that for next 6-7 years we can look at 15 to 16% kind of a CAGR. So does that mean that if the start of this 15-16% CAGR is on the lower side, your ask rate to achieve this will be higher, or will this growth of 15-16% CAGR for next 6-7 years can lower to a 12-13%?
I think we said we can do 12-13% without JP assets, and JP assets can add another 4-5% to our growth. So I think that 15-16% CAGR, including JP, will continue.
Okay. Second is in terms of the capex, is it possible any broad idea, though I know we haven't finalized to reach to a 75 MTPA, but for FY26, what number one can look at in terms of the capex?
I think we have already commented on it on both the JP transaction and the fact that we are going to announce our 75 million whenever we are ready, or the next phase of expansion. So I think there's nothing more to share at this moment.
Okay. And on the employee cost, this quarter it has come down from the last Q3 from 221 crore to 202. So is there any one-off, or is this sustainable, or when can we see normal increment for the employees, and how one can look at the quarterly employee cost from the Q1 FY25 onwards?
See, Mr. Singhi earlier was on the rolls of the company and he moved as a strategic advisor. So his cost has, under the new agreement, has moved to other expenses from the employee cost. So that is one significant change.
What could be the number? So that this entire 20-odd crore is...
Shravan sir, I will request you to kindly rejoin for follow-ups, please.
I have been told this is the last question, so I have been waiting for 1 hour.
We'll have to take question from the other participant as well.
Okay.
Thank you. The next question is from the line of Jyoti Gupta from Nirmal Bang. Please go ahead.
Good morning, sir. So my channel check suggests that, the prices have been dropped specifically in the south and east, and the drop has come from you and the peers. And of course, that is basically to maintain market share. And if, as you said in very in a subtle way to maintain market share, the prices may not improve. Now that is actually going to increase deter the entire industry profitability also. So just to, because, the companies are increasing their capacity, so obviously they have to show a minimum utilization of 70%, which means will the prices continue to take that beating just to maintain market share? And second is, I see that the raw material costs for the last 3-4 quarters have not improved. It continues to be at the same level or higher. And if that is so the case, then your EBITDA per ton for the next 3 quarters are not going to improve. I just want to understand your point of view on that.
I think on the price side, I would say that, we have not let the price drop. And I think there is, unprecedented, drop in the last quarter, which we are not a significant player in each of these markets. And like, for example, even in Andhra Pradesh, etc., we are not a very significant player, but it witnessed a significant price drop. In Chhattisgarh, we are not a significant player. It witnessed a very significant price drop too. So I think, it is not about Dalmia leading the price drop. Also, we can say in the central region where we are ramping up JP volumes, we are a very small player in that region. Even that region had price drops. So I think, this is not about, Dalmia's quest to increase market share and consequently, causing prices to drop in the market. I think there is a general tendency, what I believe, that whenever new capacities get commissioned, there is some turbulence in the market. And even though utilizations are gradually likely to improve, if demand growth grows at 9% and supply growth is at 6 to 7%, I think when new capacity comes in, there is some turbulence in the market. The question, for me, is that over the long term, how is the industry structure going to look like? Over the long term, what are the structural demand drivers? And who are the people who are investing in the sector? So I think, the encouraging trend that I see is that the incumbents, who have the maximum exposure in this sector are investing more in this sector. So I think, that's a clear indication for me that they see a long-term promise and they see, high returns. Otherwise, they would not be spending so much money. Now, the question is that will that return come in a few quarters? Will that return come in a few years? Or you have to be patient for 3 to 5 years to get those returns? I think that is the answer. Nobody knows what the answer is. But we truly believe we have seen sector after sector after sector. Whether you see steel or banking or telecom, as consolidation happens, industry structure becomes more attractive and, margins improve and, people who have built scale, before that, consolidation get a disproportionate reward. So I think this journey requires some patience. This journey requires a slightly more longer term view as opposed to a quarter-on-quarter view. And I think you have to keep your head to the ground when prices are low, and you have to, not fly high when prices are high. You have to just remain grounded. You have to remain focused on execution. And I think if you're focused and disciplined on execution, ultimately, you will get margins and good returns in this sector. At least that's our conviction. Now, let us see how it plays out. Nobody knows the future, but we are investing based on this thesis. We are betting on India. We are betting on an improving industry structure. We are betting on an industry where incumbents are, investing more, and that makes us believe that, our conviction is not shaken by just a few quarters of, weak profitability or, volatility in, prices or costs.
Thank you, sir. Ladies and gentlemen, as that was the last question for today, I would now like to hand the conference over to Mr. Puneet Dalmia for closing comments. Over to you, sir.
Thank you very much. I, greatly appreciate your interest in us. And again, as I said, this was a quarter with, good volumes, but we also had severe price drops and, higher costs. I think our cost structure should improve as we go forward. And, we look forward to interacting with you more in the coming quarters. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of Dalmia Bharat Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.